30 years ago, Poland was a cautionary tale. Empty shelves, a currency in freefall, a state economy so broken that economists used it as the textbook example of what 4 decades of communism does to a country. Today, Poland is the story economists tell when they want to prove the opposite point. It is the largest economy in Central Europe, the industrial backbone of the continent, a NATO stronghold sitting on the alliance's most exposed border, and one of the only countries in Europe that avoided recession entirely during the 2008 financial crisis. The growth never really stopped. Poland is currently the fastest growing large economy in the European Union, and officials in Warsaw talk openly about the country cracking the list of the world's 20 largest economies within a decade. That is the story everyone already knows. It has been told at Davos panels, in EF reports, and in 100 breathless headlines calling Poland the miracle of post-communist Europe. Every word of it is true. It is also quietly running out of runway, because underneath the growth chart sits a country whose foreign money is expiring on a fixed schedule, whose population is shrinking faster than almost anywhere on Earth, whose cheapest export was cheap labour, which it no longer has, and whose army now costs more than nearly any government could sustain for long without consequences. None of this is hypothetical. Every one of these problems already has an expiration date written into a spreadsheet somewhere in Warsaw or Brussels. This is the story of how a miracle gets built, and what happens in the years right after the world stops asking how it was built, and starts asking who pays for it. Because the bill for Poland's miracle has already been calculated, it is now due. Poland's transformation began in the wreckage of 1989. When communism collapsed, the country did not ease into capitalism gradually. It jumped. A finance minister named Leszek Balcerowicz designed a package of reforms so aggressive that economists still call it shock therapy. Prices were frozen overnight. State subsidies were slashed. The currency was stabilized by force. Unemployment spiked into double digits and stayed there for years. For a while, it looked like the whole experiment might fail. It did not fail. Within a few years, the shelves were full, the currency had stabilized, and foreign investors who had written Poland off entirely started flying in to scout factory sites instead. By the mid-1990s, Poland was growing again, and it kept growing through crises that flattened its neighbours. When Russia defaulted in 1998, Poland barely flinched. When the global financial system seized up in 2008, Poland was the only economy in the European Union to avoid a recession entirely, a fact its politicians still repeat at every opportunity. Investors began calling it the Green Island, a single patch of growth on a continent full of red ink. The engine behind that growth was never a secret. Low wages relative to Western Europe pulled in manufacturing investment. EU membership in 2004 opened access to the largest single market on Earth, and a flood of European money, more than any other country would ever receive, poured in to build the roads, railways and factories that made everything else possible. 3 ingredients: cheap labour, market access, and other people's money. It worked spectacularly. It also meant that Poland's miracle was never built entirely on foundations it laid itself. And foundations you did not lay yourself can be moved by hands that are not yours. Since joining the EU in 2004, Poland has received more money from Brussels than any other member state in the bloc's history. For the current 7-year budget cycle alone, the European Commission earmarked more than €76 billion in cohesion funds for Poland, on top of nearly €60 billion released through the pandemic recovery programme. Add it together, and the total tops €130 billion flowing into a single country inside one funding period. Highways that used to be single-lane country roads now run 4 lanes across the country. High-speed rail-linked cities that used to take half a day to reach by car. Entire industrial parks exist today because taxpayers in Germany, France, and the Netherlands agreed, year after year, to fund them. This was never charity. It was a calculated bet that a stable, prosperous Poland was good for the entire European project. And for 2 decades that bet paid off spectacularly. Poland grew faster than almost anyone predicted, and the infrastructure funded by that money became the literal backbone of the private economy that built itself. Every factory, every logistics hub, Every export contract signed by a Polish company owes something to a road or a rail line that Brussels paid for, but cohesion funding was never designed to be permanent. It exists specifically to help poorer regions catch up to the EU average, and Poland has spent 3 decades catching up. The math behind that fact is not complicated, and it points in exactly one direction. The richer Poland gets, the less reason Brussels has to keep sending the money the other way. If you have made it this far, you already understand this story better than most financial journalists covering it. Hit subscribe because what comes next is the part nobody in Warsaw wants to say out loud on camera. Poland is approaching the point where the numbers actually reverse. The current wave of European funding was designed to be exhausted on a fixed timeline, with a hard deadline attached to the pandemic recovery portion of the money. After that, an entirely new 7-year EU budget cycle begins, and the formula that made Poland the top recipient in Europe for 2 decades no longer applies in the same way, because Poland's own economy has grown past the threshold that qualified it for the largest payouts in the first place. That is not a hypothetical future problem. It is a mathematical certainty already built into the next round of EU budget negotiations, where poorer, newer member states and the staggering cost of rebuilding Ukraine are competing for the same pool of money that used to flow almost automatically toward Warsaw. Poland is not being punished. It is simply graduating, the same way Ireland, Spain and Portugal graduated out of the largest funding tiers decades earlier. Graduation sounds like success. It also means the free money stops. Polish officials have already begun discussing, in budget rooms if not on television, the country becoming a net contributor to the EU budget rather than a net recipient, a role reversal that would have sounded absurd 20 years ago. When that shift lands, the same cohesion fund that built Poland's highways starts pulling money out of the Polish treasury instead of pouring it in. The scaffolding that supported 30 years of growth is being quietly dismantled piece by piece, and the private economy underneath it will soon have to hold up its own weight, in full, for the first time in a generation. In 2025, Poland's fertility rate fell to just over 1 child per woman, one of the lowest figures recorded anywhere on Earth, and roughly half of what is needed to keep a population stable over time. In November of that year, the country recorded only 17,000 births in an entire month, a number so low that statisticians say Poland has already reached birth levels the official forecast did not expect to see until the early 2030s. The country's population fell by more than 150,000 people in a single year, and deaths outnumbered births by well over 160,000. This is not a temporary dip caused by a recession or a pandemic. It is 30 years of accumulated decline. Poland's fertility rate has been below replacement level since before most of the workers currently propping up its economy were even born, and successive governments have tried nearly everything to reverse it, from generous monthly child benefits to housing subsidies for young families, without lasting success. Economists studying the pattern across the developed world have reached an uncomfortable conclusion. Almost no country has ever managed to sustainably reverse a birth rate collapse once it fully takes hold. The consequence is arriving faster than the official projections predicted. Government statisticians now believe Poland's population, currently around 37 million, could shrink to under 30 million within the lifetime of the people watching this video. Every worker who will need to pay Poland's pensions, staff its hospitals, and keep its factories running 20 years from now already needs to be born by now. Most of them were not, and many of the ones who were born have already left for better paying jobs in Germany, the Netherlands or the UK, taking their own future children with them. The direct consequence of a falling birth rate is a shrinking pool of workers, and Poland's dependency ratio, the number of people outside working age for every 100 people inside it, already tells the story. In 2025, for every 100 working age Poles, there were roughly 42 people of retirement age relying on them, nearly double the share recorded just 3 decades earlier. The population over 65 now makes up close to a quarter of the country, and that share grows every single year while the number of young people entering the workforce keeps shrinking behind it. For now, Poland has managed to paper over the problem. More people are staying in work past retirement age than ever before, and previously inactive adults, especially women, have entered the labour force in record numbers, which is why the raw number of employed people in Poland recently hit an all-time high, even as the total population kept falling. But that is a trick you can only pull once. You cannot pull previously inactive workers into the labour force a second time after they are already in it. After that, the only remaining lever is immigration, and Poland has leaned on it heavily, absorbing large numbers of Ukrainian workers since 2022 to fill gaps in construction, agriculture and manufacturing. Immigration buys time. It does not solve the underlying arithmetic because a workforce built on migration can leave as easily as it arrived, and the demographic hole underneath it keeps getting deeper every year regardless of who is filling the gaps today. And the industry built to employ that workforce has a problem of its own now, one that has nothing to do with how many workers are left to hire. For most of the last 3 decades, Poland's single greatest selling point to foreign investors was simple. Labour was cheap. A factory worker in Poland cost a fraction of what a factory worker in Germany, France, or the Netherlands does, and that gap was wide enough to justify building entire supply chains around it. That gap is closing fast. Polish wages have risen by high single-digit percentages nearly every year for a decade, and even after recent cooling, average pay in the corporate sector was still climbing by more than 6% annually in early 2026. Roughly a quarter of all Polish employees currently earn at or near the minimum wage, one of the highest shares anywhere in the European Union, which means every increase to the wage floor ripples straight through the entire economy rather than staying contained at the bottom. Poland's own trade officials have started admitting publicly what investors already know privately. The government's own 2026 trade report states plainly that competing on labour costs alone is a model that is gradually losing relevance, and that the country's future depends on automation, innovation, and higher value production instead. That is almost certainly the right long-term strategy. It is also, in the same breath, an admission that the exact advantage that built Poland's manufacturing base for 30 years is disappearing, and nothing has fully replaced it yet. Polish manufacturers are now pouring money into robotics and automated production lines, for the same reason German manufacturers did a generation earlier, because paying for machines has become cheaper than paying for the workers those machines replace. Meanwhile, the currency itself has quietly worked against Poland's exporters. The zloty strengthened significantly against other major currencies over the past 2 years, which sounds like a sign of strength and functions in practice. There's another tax on every factory trying to sell Polish-made goods into markets that used to be won on price alone. There is a name economists use for what Poland is now approaching, and it is not a flattering one. The middle-income trap describes a country that grows quickly by doing what poorer countries do: cheap manufacturing, cheap assembly, cheap exports, and then stalls out the moment those advantages fade, because it never built the second engine that rich countries actually run on: original technology, globally recognized brands, and companies that set prices instead of accepting them. Poland builds an enormous share of the world's cars, appliances, and electronics. It owns almost none of the brands stamped on the outside of them. The value that actually makes a finished product expensive, the design, the software, the brand recognition, mostly sits somewhere else, usually in Germany, South Korea, or the United States, while Polish factories absorb the labour-intensive middle of the supply chain. That arrangement worked beautifully when Polish labour was the cheapest input on the table. It becomes a far weaker position the moment that advantage narrows, because a country stuck assembling other people's inventions has no pricing power of its own left to fall back on when costs rise. Breaking out of that trap requires decades of sustained investment in research, education, and homegrown companies willing to take the kind of risk that pure assembly work never requires in the first place. A handful of Polish firms, mostly in gaming and software, have started down that road and built names that international customers actually recognize. Most of the economy has not, and the closer Poland's wages climb toward Western European levels without Western European brands to show for it, the harder that particular gap becomes to close. Poland sits on NATO's most exposed border, sharing a frontier with both Russia and Belarus, and since the full-scale invasion of Ukraine in 2022, it has responded by building the most heavily funded military in the alliance relative to the size of its economy. Defence spending reached roughly 4.5% of GDP in 2025, already the highest ratio anywhere in NATO, and the government's own 2026 budget pushes that figure even higher, close to 5%, on the way toward training and equipping 500,000 soldiers by the end of the decade. For comparison, the United States spends just over 3% of its GDP on defence, and Germany only recently reached the alliance's old 2% target for the first time. Poland has stopped meeting the NATO standard and started setting it, almost entirely alone. That commitment does not come free. Poland is currently running one of the largest budget deficits in the European Union, expected to sit above 6% of GDP in 2026, and the country remains under formal EU monitoring for breaching the bloc's deficit rules. Public debt is projected to climb past the EU's own 60% ceiling within the next 2 years. None of this spending is optional in any meaningful sense to the people making the decision. Poland's government has argued openly that a small deficit is worthless if the border behind it cannot actually be defended, and few of its European neighbours are in a strong position to disagree with that logic. But every zloty spent on tanks, ammunition, and 500,000 soldiers is a zloty that cannot simultaneously modernise the health system, close the pension shortfall building up behind the demographic cliff, or replace the EU money about to disappear from the budget. Poland has chosen deliberately to be Europe's shield. Shields are expensive, and this one comes with a bill attached that grows a little larger every single year it stays raised. None of these 4 pressures, the fading EU money, the shrinking population, the end of cheap labour, or the cost of the shield, is capable of ending Poland's economy on its own. Together, arriving inside the same decade, they represent something closer to a ceiling than a cliff. Poland is not going to collapse the way some of its neighbours have collapsed. It built genuine institutions, genuine infrastructure, and genuine industry over the last 30 years, and none of that disappears overnight simply because the funding formula changes. What disappears is the free momentum, the years when growth arrived almost automatically, because the money was flowing in, the workers were plentiful, the wages were low, and the defence budget was still someone else's problem to worry about. What happens next depends entirely on what Poland does with the runway it has left, and that runway is shorter than the headlines about the fastest growing economy in Europe would ever suggest on their own. Every miracle economy in modern history, from Ireland's Celtic Tiger to Japan's post-war boom, eventually reached the same fork in the road, the point where borrowed momentum runs out, and a country has to prove it can generate growth entirely on its own terms. Some countries made that transition successfully, others did not, and spent the following decades explaining what happened to the miracle everyone used to talk about at dinner parties. Poland is standing at that exact fork right now, in real time, while most of the world is still telling the old story about shock therapy and green islands. If you want to understand how the next chapter of the European economy actually gets written, this is the story to watch closely, because what happens in Poland over the next 5 years will tell you more about the future of the continent than any single headline about GDP growth ever could. If this breakdown helped you see past the miracle narrative, subscribe for the next one, because Poland will not be the last country whose bill comes due.